Ben Meikle, Director of Asset Management from Carnbrea & Co, Benelong Wealth Partners.
Clarke, founder of the My Real Estate Mate group of companies.
I know there's been a lot of anticipation about this sit down. I sort of get the feeling that I'm here from the group that I work from, which is Carnbrea.
Yes.
So I set up the asset management team there 2.5, 3 years ago.
Right.
And we focus on outsourced CIO or outsourced investment management function for funds. So we've got 3 funds operating at the moment.
Right.
Really boutique. So we specialise in unique overlays, whether it's ethical. So for example, we've got a Sharia compliant fund. Also, if there's a tilt or a thematic. So we're very strong in venture capital and private equity.
Right.
So what I'm finding is that we end up building a lot of product. And what we do is we don't go out and build product and sell it.
Right.
We engage with these distribution channels that are servicing a unique demographic or cohort that want product to serve their clients better.
Right.
So it's sort of a completely different process in terms of how we approach building this product.
Right. Completely re-engineered.
Well, we're looking to sort of connect with the marketers and the sales teams.
Yes.
Unlike the banks, we're not unlike the banks where these guys are just flogging the product.
Right.
We're looking to try and listen to what their client base or cohort or demographic wants, and then build the product for them to deliver.
Right. And it's probably a good way to do it with the current banking inquiry. We're finding that some of these products and the way in which it's been gone about the delivery of that product's got something to be desired.
Oh, it's terrific. Sort of like a fast food chain. These banks have just been like shoving, cholesterol-laden, fat, unhealthy product.
Yes.
Poor performing product down these end users' throats. And these consumers are just fat and overweight, obese, health problems with their financial situation.
And I think it sounds, probably we do a lot of that as well, and I think it stems from in our real estate industry, the education and the qualifications that are required of real estate agents selling and providing product to end buyers, families, owner-occupiers, and also the investment, wealth creation type buyers. So we as well have websites that are for the end consumer, whereas we advise then developers and provide product based on live market data. So a lot of the real estate business is based on research, which we call research as reactive and therefore really not that important on the day-to-day current buying power of consumers. So a lot of these websites are there to educate and make qualified decisions. So a lot of these people take 6 months to 2 years to even find a property, and once they've found it, coming back to your point with money and products, they find that they actually can't afford to buy it because they've been given the wrong advice to begin with. So it's funny, it's a big gap in the market, I think, in terms of education and expectation for consumers and the people providing the finance and products.
Well, exactly. Product's essential. It's like there is no market unless you've got a product.
Yeah.
But it's how that product is distributed, engineered, manufactured as such.
We used to find that we used to distribute a lot into the international markets, which is predominantly Asia Pac, so Hong Kong, Singapore, Malaysia, and through those type of areas. The current change in stamp duty regulations have meant that a lot of those buyers have therefore exited the market, or waiting for that stamp duty to be reinforced again. And I think a lot of that is putting a lot of pressure on the local market. So there's a lot more actual product in terms of physical, not in terms of finance product, but physical off the plan or built under construction product that basically, there's just less buyers in that market because they're local. And the locals have probably been pushed out of that market for the past 6 months to 2 years. So their, probably their motivation to re-enter that market is probably not what it once was.
You look at the corporates out there, the UBS and the Macquaries and even more recently with the Royal Commission, the banks, and they've just got it so wrong in terms of integrating a philanthropic, drive or interest, endeavour doesn't exclude that you can operate in the financial domain.
Right.
So it's a real sort of integration and hybrid to sort of operate both.
Yes.
And when you sort of come across like-minded people or even organisations or endeavours like what Sterling's doing here, it's a far different feeling than walking into Macquarie Bank boardroom and hearing a seminar or pitch or having a meeting.
Yes. As like an adjunct, I think, and probably, I compare everything, that we're doing in this sphere back to, America, and it's, a passion, and really that philanthropy comes even before the business, because it's about generating that wealth and kind of giving it away, instead of here, probably it's being just a younger nation generating wealth, spending it on toys, and then going, we're going to give 10% over there because that seems like a good thing to do at the time, or everyone else is doing it. I think it's also about holding each other accountable to say, well, when you're, getting on in years, what do you want to be known for? Everyone's going to know that, you've been successful in this business endeavour, but have you actually built a school, or built X number of wells in the outback, or given back in some certain way? And I think that's a lot more of a poignant finish to your career, or to your legacy to then give on to the children.
So within your property business, do you run any funds or fund management structure, or is it more just the delivery, or?
More so just the delivery, and we do have a lot of people that come to us with funds, and then we allocate them to different areas. My strong suit's probably as an entrepreneur and deal maker, rather than admin and product and so forth. And that's also from a logistical point of view of more people on the team, and more recording and data and so forth.
So we deal with any property funds? You'll invest their allocation into different property projects for them?
Yeah, absolutely. So we'll just basically as a conduit to put people in contact and go from there. We've got 500 websites, so we're probably the largest owner of domain names and websites in Australia. So our ability to then distribute that to other real estate agent, wholesalers, or retail agents is quite a powerful tool. But we have, as part of our portfolio, a company called Going Green, which is all about sustainability and actually building these properties in line with not only 5-star but now 6-7-star energy ratings and so on. And a lot of developers will then come to us and say, here's this development, here's the plan, it's been approved, and we'll say we actually need to change it for these reasons, airflow and ventilation, so it's therefore going to be less of a cost for power and energy usage and so on. So I think in our industry that's going to be a very big thing. We're also seeing timber buildings as well, for example.
That's similar to probably the ethical overlay that's coming in the fund management space, where ethical investing is now increasing at the quickest rate.
Yes.
All the major funds are looking at how they can apply their ethical filters.
Yes.
So probably draw a parallel between that and that sort of green focus.
And I think the market in general is heading to that medium density. So a lot of the mixed use and townhouse markets. So a lot of these properties are in family portfolios, and particularly if they want to find a property to live in, in future life, or downsizing, then they're actually now having to demolish their existing home and put up, say, 3 townhouses, or demolish that building and need assistance with the funding and the design and the architectural methods to do that. And they are thinking long term, because they're thinking, I might be now 60 or 65 years of age, or actually downsizers are actually, in terms of an age bracket, are now as low as 50. But they're thinking, this is now 2nd, 3rd, 4th generation that will be living in this building, so we want to make sure that it's actually designed in a sustainable manner. We can all, put up a building with just tilt slab and away we go, put it together like Lego. But I think as well that's a lot more interest in design and that art aspect. And there are certainly some examples in recent completed buildings, whether they be commercial or retail or resi, and they're not exactly the most spectacular things to look at. So I think as well for urban sprawl, it's also about what's appeasing to the eye and what's going to be sustainable.
Yep. What about the super funds heading into the industry super funds, sort of heading into that commercial building and property space? How do you see them manoeuvring? Do you think they've been successful the way that they've entered the space?
I think they have been. If you look at examples like an ISPT, for example, they've done very well. I think it's where the opportunities are that are actually big enough for them. So it's going to be in those areas like a Fisherman's Bend or the Bays Precinct in Sydney, where they've actually got scope to expand, and they're building industrial hubs for someone, say, for example, like an Amazon. So I think where they're coming into their own is they've got the capacity to do projects where even the largest private or listed property companies are shying away and saying it's actually even a bit too big for us.
And are they really stepping into that space and taking some of that those larger scale projects?
Yes.
Are they starting to emerge as dominant players?
I think they are, and if they're not coming in as the dominant, they're coming in as, say, a joint venture partner, and it's kind of that
upskill and get the expertise.
Absolutely, yeah, and we see that a lot. It's funny how someone, and that someone could be a company or the super fund will start by an initial investment. And then the next deal is a joint venture, and then all of a sudden they've said, no, well, we bought that parcel, and you'll say, yes, but the person that you had the joint venture with and that initial investment were also looking at that, and they said, oh no, don't worry, we've already bought it. You think, right, well, that was a very quick learning cycle for you, but you're onto it, yeah.
So there's a lot of commentary in the property domain. I'd love to hear it firsthand. I think UBS came out and slashed Westpac today due to their loan book.
Right.
I know that you sort of mentioned the tailwind starting to fade. Are you seeing any real sign of that out in your conversations and on the coalface with activity towards property?
I think it comes down to, from an individual private point of view, is sheer affordability. I think particularly with residential, the market has been very strong. Even with interest rates at a low level, the growth has really outgrown wage increases. So it is, I think, probably at, and I hate to use the word, like a property clock, but it is at a level which is very much unattainable for a large majority of the population. And I see, a lot of the companies and investment groups going for a lot of retail and commercial over now, say residential development, and that is due to basically the costs of labour and cost of cement and steel and things like that, and then to really the larger developers that have been in, say, residential or mixed use now moving towards maybe a hotel model or office space. So I think a lot of experts in the industry and a lot of long-term players that have been just in one sector are now spreading their wings into others. And I know from a commentary point of view, people say, well, property is property, but they're very different levers in terms of residential, commercial, retail and industrial. And, kind of historically never shall they meet. Whereas now you've got to be very flexible. And things, bringing back to technology, like Airbnb, for example, has been a huge disruptor, not only for the rental market in residential, but also then the hotel market. So it'll be very interesting to see the value of then hotel asset classes, where it be valued on a per hotel room or profitability. And then, of course, hotels that have varying levels of profit. The 3 and 4 stars typically make more than, say, a 5 or 6 star, service hotel with a lot more, obviously, staff cost better location, so the acquisition cost was higher. It's funny. We were at Crown the other night, and it was actually from Anzac Day Eve, and we got about 5 different bits of paper from 5 different people under the door saying the gambling floor would be closed, and then we had one person bring in a bottle of champagne, another person bringing some chocolates, another person with room service. So you think, well, we've seen about 10 different people in the space of 2 hours, going down to the restaurants, and still, if that was a 5-star hotel without the gaming, you think, well, how would that actually be a sustainable model? And I think that's really led to the popularity of Airbnb, is because as a traveller, really now there's so much, you're exhausted by the time you get to the airport, and the wait times are huge. To a hotel, you actually want less conversation and interaction with people. So I think that's as well been really the main driver with Airbnb, and also the affordability factor.
So with the Royal Commission, we've seen there's been a systemic issue with the process of advice, the governance of advice, advisors just giving very, very poor advice. There's one example where one of the Westpac advisors, actually newly appointed advisor, was unqualified and had his own property development business that he was recommending clients to go into.
Yes.
So we understand that the evidence is showing that there's a terrible issue with the way that the big banks, which own 80% of the market, are giving advice.
Yes.
They're very, very property focused and centric. We know that they've got their loan books. They stand to benefit from more property investments.
Yes.
Do you think that could be a shock through the property market, that as we start to see some slight adjustments, some different levers move, interest rates, property prices, title lending, do you think all of that bad advice, which has been fueled with low interest rates and growing asset prices, has been self-fulfilling, do you think that bad advice could be that rotten apple in the barrel as well, or could be something bigger that will then spread? Do you think these investors are over leveraged, which we now have a clear reason why? Yes. Is there a link there, or is that
absolutely.
Is that too big a quantum to jump?
I think there are a lot of, whether it be, say, an investor group or they're like social platforms and so on, and I think a lot of people have bought a lot of investment property on the rise, and I think that we've been in a very healthy interest rate environment. And I think, though, what you'll find is with a lot of these properties, as they settle, as they come to market, I think then the bank or the mortgage broker will actually say now, with a lot of refinance, is instead of just being able to pay interest, you will now have to move into an environment where you're paying principal and interest. And in that case, if you had your principal place of residence and maybe 1 or 2 or 3 investment properties, to then pay principal, well, you can probably only sustain 1 property and 1 investment property.
And what level do you think the advice has played in that?
I think a lot of it might have been future projections in terms of your capital growth, with it doubling every 10 years. And this has been a common theme in Australian property for generations, is it'll double. And, if you asked every 50 or 60-year-old what they paid for their home, in the 70s or wherever it might be, they'll say, well, actually, that has been our best performing asset. And because almost by default, their family home has been their best performing asset, they've kind of led with that strategy with further properties.
Confirmation bias.
Correct. And also then, I think a lot of these buyers have, bought properties in those growth areas that are very much, driven by resources. So those towns like, say, Karratha, Portland or Gladstone, Mackay. So they've gone from probably what is more of a stable environment to one of more, peaks and troughs, even though we've seen, very consistent growth in those areas. So I think it will come down to their lifestyle, and I think they'll need to be prepared to make changes on their lifestyle if they need to be paying off principal. Because if you look at, the average home now, there's 1.2 million, plus, if you've got 1 or 2 children, whatever it might be, the actual sheer volume of cash for a household is actually huge to keep that and maintain that. Let's not even think about toll roads and petrol. It's a large quantum of money. And I think the other thing will be credit card debt, and I think that is huge. And I think a lot of households forget about how much is, being effectively on that automatic debit. And I think that's a big thing. You do the gym or you subscribe to a magazine or whatever it might be, everything's on a credit card. And I think there's probably a lot of households out there that don't realise the level of their debt and the time and money that is required to then get that debt down. And I think at some point in time, people will come in and say, we actually need to get rid of that debt, and how are we going to do it? I'm not sure what the timing is of that, but I think it is going to be upon us sooner rather than later. Well, that's been awesome.
Thank you.